JSW Steel's reported numbers were much ahead of Bloomberg estimates. You could argue that sequentially the numbers were lower, but those are to be anticipated and much better than anticipated, as I said, both on the operational metrics front as well as on the top line front. Mr. Jayant Acharya joins in right now to talk about how the quarter went by. More importantly, from where he's perched, how does he see the economic factors impacting the next 9 months? Mr. Acharya, great having you. Thanks for taking the time out. And to my mind, congratulations on a good set of numbers.
Thank you very much. Happy to be here. Just to set the context a bit, the global economy, while it remains challenging, has been resilient in the last 2-3 months. We see better than expected growth. World Bank has increased the outlook by about 40 basis points. We see some recovery in some parts of the world. And inflation, moderating inflation, lower commodity prices, lower energy prices have been supportive. And we see a very strong India business momentum, which is continuing to be driven by both the business and consumer sentiments. Both services and manufacturing are doing well. In India, the inflation is moderating as well. Manufacturing in India is now getting supported by the capex from the government through the PLI scheme. The focus on infrastructure and construction by the government of India continues. The supply chain realignment, which is happening globally, is favoring India, and so therefore the manufacturing activity is picking up as well. So we see good traction in India, and the preference by many countries is now to set up global capability centers in India as the India outlook demand improves, and we already see FDI and FII capital coming into the country. So that's very positive economically. So global positive to some extent, while challenges remain, but India certainly much more robust. Global steel production during January to May has moderated marginally by 1.2%. However, the moderation has happened in the rest of the world, while China was positive 1.6%. The Chinese demand did not play out as was anticipated earlier. The demand has been subdued, and the elevated production resulted into more exports, which remains an area of concern. However, the Chinese government has articulated its view that they would like to cap the production to calendar year 22 level, which means effectively that H2 of this year, there would be a moderation, which would be good for the global steel industry at large. Indian steel industry in Q1 has grown by 10% to 30 million tons plus, and we see a growth in the range of at least 8 to 9% for the full year. We should incrementally add 10 to 11 million tons, which would take the annual consumption in India to more than 130 million tons. Demand, as I said, continues across various sectors, including infra, manufacturing, automotive, renewable, and increasing private consumption. The raw material side, coking coal prices, which were higher during February, March, which flew into our cost in Q1, has moderated, and some of those lower costs are going to flow into our Q2, and therefore will benefit us. The iron ore prices have not corrected to the extent desired or expected. We are expecting some more corrections to come in the remaining months. Steel prices have by and large bottomed out, and we see that the channel destocking, which was in process, has by and large been completed. Therefore, at the backdrop of all this, if you see, JSW Steel in Q1 has done quite well. We have been able to manage our costs, although the coking coal costs increased by about $11 to $285. We managed with a better value-added product portfolio and a better export portfolio, which we had booked in the earlier months, which came into this quarter. So we had a better NSR sales realization, and therefore a slightly better sales realization. And although the iron ore cost went up and the coking coal cost went up, we were able to contain the cost by a better management of the blend. So therefore, our EBITDA per ton at 12,345 rupees per ton was more or less similar to the last quarter, quarter 4. On a console basis, as I say console, this is reflective of our JSW steel operations, including BPSL and coated. I think going forward, we expect, as I said, good volumes on quarter 2. The demand is improving. We added some inventory in quarter 1, primarily due to the cyclonic impact in the later part of the quarter, June, and some part of the Western sales which got impacted because of the cyclone. We expect to liquidate some part of that inventory during the coming months.
Okay. So if I hear you correctly, and just talking about quarter 2 first and then moving on to the rest, there will be steel prices are bottomed out. Hopefully, iron ore costs will come off. Other costs are also coming off, I heard you say, and you expect better volumes as well. In a nutshell, while I thought you've given a strong quarterly performance both on the sales relatively YOY as well as on the EBITDA front, Q2 you reckon might be better than Q1?
So on an absolute number, I would say that Q2 would be, having the leverage of a better volume. It will also have the impact of lower coking coal prices. We see about $45 to $50 of coking coal price drop, which will flow into quarter 2. And while the prices have bottomed out, so this would therefore, lead to better performance in quarter 2.
Got it. Just trying to think of the next 9 months, Mr. Acharya. We have an unpredictable global scenario, although I read your press release and you talk about the uptick expected for the global economy as well, but let's assume that it doesn't quite stay as well or stays at constant or maybe lower, but Indian construction season might begin post monsoons. There is hope of some more infra spend from the government side as well. Do you anticipate H2 to be significantly better than what H1 could be for you?
So I would say globally, you are right that the challenges are not predictable. While we have seen a slight improvement from the point of view of sentiment, because the lows which were expected globally have subsided, and we see that people have averted recessions and are slightly recovering in some parts. But India, we expect will continue to be robust. Infrastructure spend by the government of India is very focused. If you really look at the road construction in the month of May, as I saw it, it was 50 kilometers a day. We see high impact on metros. We see high impact on high-speed rail. Renewable energy to the extent of about 45 gigawatts is expected to be added in the next 2 years. We see water pipelines, housing, again, activity improving. So we see actually a very good traction coming in this year. And so therefore the H2 volume will pick up, supported by a good demand, number one. Number two, it will also get a ramp up of production volume from our BPSL capacity expansion, which gets completed in H2, and the inventory liquidation, which we added in this quarter. So therefore, overall, it seems to be positive. We remain confident that we'll be able to meet the guidance which we have given.
Lovely. What is the risk to this? Could it be even softer China and thereby impacting of pricing and demand, or the US actually having a hard landing combination? What to your mind is the biggest risk?
So the China domestic economy, I think, is a concern because the inflations are at very low levels. And I think the government is recognizing that, and we hear there are steps being taken to provide policy support in the near future to some of the sectors to improve the domestic demand. That would be positive. In the US, while we have been expecting a slower economic activity, however, US has held up very well. The service sector has been strong, and while the manufacturing has been slightly weaker, but we do see that the Inflation Act, the CHIPS Act, and other onshoring efforts which is being made by the government is holding up the economic activity well. There could be some impact of the interest rate hike which may come, and that would impact some part of the global, I think, economic recovery. But having said that, I think we have still till now done better. So the risk, I think, is a little bit more towards what China does in the future in terms of policy announcements and how that plays out in terms of the global situation. India continues to be strong. I do not expect that India will get impacted materially in this financial year.
Okay, my final question, Mr. Acharya, and that is, if I look at the next 18 months, I've heard you say that about Q2, about H2, hopefully being better as well. And as I read, a clutch of your expansion plans, be it Vijayanagar, be it phase 2, etc., all of them looking like getting completed by end FY24, and therefore FY25 also having the benefits of a larger capacity subject to demand being there, which I hopefully will be there. So you're looking at a period of optimistic performance over the next 18 months. Would that be a fair assessment?
I am very optimistic about India for the next decade. And this is the nation building decade. And I think it's something which all of us should take the opportunity to grow along with. The capacity expansion of about 9 million tons, which is coming in by FY25, will come in from March 24 onwards, and that would certainly improve the overall volumes from JSW Steel. Also, we expect that the demand incrementally, even if it grows at 8% or 9%, we continue to add 10 to 11 million tons every year. So if you look at a scenario of 3 years or 4 years, which is required to set up a steel plant, about 30 to 40 million tons of incremental demand would be added in the country. I see that as a big positive. We also are seeing that the per capita income in India is going up, and therefore private consumptions are improving, which is reflected in automotive, which is reflected in appliances, which is reflected in packaging, and which is reflected in housing. So as the country grows, as the economic activity grows, we will see all around growth, not only in the urban side, but the rural side as well. And that would support overall economic activity and therefore the steel industry.
We wish you all the best for all of that and more. Mr. Acharya, thanks so much for taking the time out and speaking to us today.
Thank you very much. Thank you, Neeraj.
Thank you. And viewers, thanks for tuning in.